Most high-income earners are excellent in making money and surprisingly unoptimized with the real estate. And the same three mistakes are showing up over and over, quietly costing them tons of money. That makes sense. They're focused on making money, and real estate, feels like something a bit on the back burner. So it gets managed more on instinct rather than strategy. But owning real estate and owning it the right way really are two completely different things. And the gap between them is where the money leaks. I work with business owners and high-income earners every day, and we see exactly how real estate, their business, personal tax picture, all connects. That is precisely why these three mistakes are so easy for us to spot and so expensive when they go unaddressed. So in this video, I'm going to break down the three real estate mistakes that most high-income earners are making, and I'm going to show you the same things that we're walking through with our clients right now. So first thing, let's just get an understanding of what's going on with real estate currently. We came out of a season of really low interest rates, and that formed a lot of bad habits in the real estate investor market where you just had to own something and it went up. But over the last 5 years, interest rates have really skyrocketed, and things have really become tough sledding. And we've seen challenging landlord laws. And so just owning it and making great money is not exactly working anymore. We're also finding that investors have kind of forgotten the reason why they even invested in real estate to begin with, which is really for income, which we're finding is frankly super rare. A lot of them invested for appreciation in the recent years, thinking it's just going to keep skyrocketing, and it hasn't. So let's go into the three mistakes, and then we'll talk about what do we see that actually works and makes real estate fit really well inside of a plan. Mistake number one is structurally. We got to start with the fundamentals. Each property owned in its own LLC and has its own bank account. Organization by separation is crucial. Once we have each property owned by its own LLC, that's when we start to discuss the holdco strategy to layer on top. Let me show you an example of what that looks like. So this is simply what a holdco strategy looks like, where you have three separate LLCs that individually own the buildings, and then there's a parent LLC that owns those individual LLCs. Now, why would we do this? We're doing this for administrative simplicity, the benefits of a management company, and estate planning. We're not doing this for tax reasons. This is not some secret tax trick that a lot of the TikTokers are harping on. So once we have the right entity structure, we also need to consider the balance sheet structure. And what type of real estate are we actually going to buy? We're beginning with the end in mind. So are we buying commercial? Are we buying residential? Is it going to be value add focused, or are we going to buy for cash flow? See, most investors are not beginning with the end in mind. They're arriving at 70, and we're having a lot of conversations with these 70-year-olds. They're dissatisfied. It's not what they thought it was going to be. They're really tired of managing things, and now we're locked in with this tax bomb that we have to contend with if we want to get out of it. Really, that's why 9 times out of 10, we're steering clients towards triple net commercial real estate. And I'm going to expand on that in just a minute. But that's mistake number one. Let's talk about mistake number two. Mistake number two is not utilizing all the tax strategies available to you. There is accelerated depreciation, where we choose to take more tax savings today. There is taking qualified real estate professional status, where we actually are able to pull tax savings from the real estate and use it against ordinary income, like their spouse's W-2. We had a client make multiple millions of dollars last year who paid no tax because they used this strategy well. Another example is doing a cost segregation study on a building that you own and run your business out of. That's going to allow you to buy your building at an extreme discount. And there's many more tax saving strategies. Sometimes some of these upfront tax saving strategies actually hurt down the line. So we need to, you're going to hear me talk about in so many of my videos, that's where we're doing modeling, and we're deciding what tax strategies we even want to implement of the many that are available, and not just taking the one that sounds the best or saves me the most today, but I want to use the tax strategies that are going to save me the most over the long term. Now that you've seen how the wrong structure and not using all the tax saving strategies out there are affecting your real estate portfolio, and you want a real plan that's actually built around your specific situation, click the link below. Schedule a call with our team at Perspective Wealth. We're here to look at your situation and show you how to optimize your plan altogether so you can apply this to your situation. Now, let's talk about mistake number three. Mistake number three is not treating your real estate like it's a business. There's this mailbox money concept that's mostly a myth at this point because most people have not actually built their portfolio in a mailbox money way. They're out mowing the lawn of their college rental that they own. So here's the reality. It needs to be treated like a business. That's why I said it needs its own bank account. Once it has its own bank account, we can create its own P&L. Once we have its own P&L, which I rarely see, but once we have its own P&L, we can actually start to treat it like a business, make sure that it's performing. We just had a client with a $100 million real estate portfolio that was underperforming by $2 million a year in income because they didn't have separate P&Ls. So they really didn't know how each property was performing, and they had over 20. So it was very overwhelming, and they started to have literally millions of dollars of leakage. But for most investors, we're seeing this cost them maybe not millions, but often six figures. So now that you've seen the three mistakes, how they compound, let me show you what it actually looks like to get your real estate working with the rest of your plan instead of against it. We get the right entity structure, we decide the right tax moves, and we begin with the end in mind. We're able to build something that we call the perfect trifecta. Most of our clients' situation look just like this. They've got a business where there's good equity, or they have equity in a business that they work at. We want strong liquidity, and that's where there's room for passive income. Really where real estate shines is passive income. That's why we really like commercial real estate. Commercial real estate offers a structure where you can invest and find a tenant, set up a structure where it is a triple net lease. And a triple net lease allows you to really outsource all the management to them, the tenant, and you are actually just collecting checks. We also are desiring a 4+% cap rate. Now, cap rate is essentially the income that I'm making on the value of the building. We're not considering debt. We're just considering the value of the building and how much income is coming off of that. So for every $1 million, I should be expecting $40,000+ a year after expenses. We find that a lot of real estate is underperforming that. But if I can create hands off 4+% a year, now we have true mailbox money. I like to share an example. We have a client that owns a Starbucks building. That client's getting $25,000 a month. And frankly, it is harder for them to go buy a coffee in that Starbucks than it is to own the building. That is where real estate really makes sense in most of our clients' situations. And that's why we created the perfect trifecta. Now, you've seen the three real estate mistakes the most high-income earners are making, from holding the property in the wrong structure to treating it as a set it and forget it. You can stop letting your real estate quietly leak money. You can start making it work with the rest of your plan. If you want a real plan built around your specific situation, click the link below. Schedule a call with our team at Perspective Wealth. We're here to show you exactly how to get the most out of your real estate, get it working for your specific situation. I'll see you in the next video.